Hello, viewers. Welcome once again to an episode from the Wisdom Bank podcast studio where we shows are mostly educational and we bring great information for personal consumption. And and as my greatest joy is to have Mr. Bruno in the studio. Mr. Bruno, welcome.
Thanks for having me. Appreciate it.
And as always, so much. I'm so happy. I'm so happy to always have you in the studio.
Thank you.
So, Mr. Bruno is a consultant, an entrepreneur, and also an author. So, Mr. Bruno, thank you for all that which you do for the community.
Appreciate it.
I might have omitted one or two things about who you are. Just shed more light on who is Bruno Njowi.
Well, thank you, and thanks for having me back. It's always a pleasure. So my name is Bruno Francois Njowier. I live in the great state of Minnesota. I am a serial entrepreneur, I would call it. I founded and run a firm called Francel Global, and we're in the healthcare sector. We own a medical center, one of the best private medical centers in Cameroon. We are in financial services as well, because that is a lack in our community, especially immigrants, and we're equally in real estate, both in the States and back in Africa. So, and then we run a philanthropy as well. So we run Marie Selin Foundation, which is centered around disabled and orphans. So those are the things we do for the community.
Thank you so much for that. So, what we need to give honor to whom honor is due. I really want to sincerely say thank you. Yes, so you have been so much impact to me. Dear viewers, if you are a returning subscriber, thank you so much for coming back. If you are new, please subscribe to our channel, and we promise you we're not gonna fail you. Mr. Bruno, we are discussing a very sensitive topic today. And since we started, I started reading a lot of books, especially the books you've recommended and the ones you've written. So I've digested them, and I want to say thank you.
You're welcome.
When you meet a family or an individual, and you are nursing the grounds of wealth building, how do you lay that playing field?
So first of all, you gotta understand the steps that are required to build sustainable wealth. Now, anyone out there on the internet or somewhere can tell you what it takes to build wealth. I don't know what works for them, but having studied one of the wealthiest people on earth and understood what they've done, they may not say it in public, but you understand they have a psychology to building wealth. The foundational step is protection. So we got to talk about protection. There's the foundation of building wealth. So in my book of business, we have to handle that first. You got to protect, what is important to you, your family, yourself, and your ecosystem, so to speak. And then we move on to debt management, and then emergency fund, and then investing. So when I'm talking to anyone, the genesis of it all is we got to figure out protection, because that is the one aspect that can deter any plans you have of building wealth, of building a life, so providing for your family. If you can't take care of that um, basic need, it is almost impossible to build something long lasting or sustainable. So that's the genesis of it all.
In our last episode, you were laying the groundworks, and we promised ourselves that we're gonna do episode 2 on wealth building. And you touch on a very, very important facts that people might see it different. We talked about insurance. Before you buy a house, you have not even signed a house. They first of all need what? Insurance.
Protection.
You go to Walmart. You go anywhere. You want to buy something, they ask for that insurance. But nobody wants to really protect his life or her life or that of the family. As a consultant, can you define the term insurance and life insurance? Because those are two different terms.
So insurance, rightly said, insurance is transfer of risk. That is the most basic way I can put it. Is taking the liability from yourself to an entity, to someone else. So it's me going. If something was to go south, I don't want to bear the responsibility myself. I want someone else to step in and take care of that. So that's it, in the most basic way is what insurance is. You're transferring risk to an entity or to someone. Now, life insurance, if we use that psychology, then life insurance is you protecting, transferring the liability of your life to an entity. Basically saying if something was to happen to me and I lose my life, I want this entity to be responsible for or to pay out a lump sum to whoever it may concern. All right, whoever you designate as a beneficiary would then claim whatever that lump sum is. All right, so that is where that is life insurance in the basic form, if I can put it that way.
Who needs it?
Every living creature. Okay, I would probably want to rephrase that. Every living human needs life insurance.
Need life insurance.
Yeah.
And why do they need it?
So now, for people who really care about themselves, about their communities, about their families, about society, you need life insurance because you don't want to pass on the financial burden to people who are probably not ready to handle it.
Wow.
We're talking about kids, who are not old enough to work for themselves. They're still in there, probably, 2, 3, 4, 10, or below 18. We're talking about your spouse, who, as a couple, both incomes are handling the household. And now, if your income is completely gone, if their income is not enough to handle the household, you're leaving them a financial burden. So life insurance is for everyone who is intentional and who cares about, their spouse, their family, their community, their, the people they're living behind, especially dependents. So it's for anybody who cares enough to want to make sure that if in the unlikely event of them passing away, either timely or untimely, their family has a financial head start.
Wow. Now, we pay for car insurance. We pay for phone insurance.
Yeah.
We pay for home insurance.
100%.
But when it comes to life insurance, we don't really want to do that. Why?
I think over the years, life insurance has had a bad rep or a bad publicity, so to speak, because I grew up in Cameroon. I'm an immigrant. So from Genesis, and this, having talked to thousands of immigrants, I can tell this is true across the board. It's not, I thought it was a Cameroon thing. But when I'm talking to someone from South Africa, from Kenya, from Ghana, from Ethiopia, it's the same mindset that when you hear the word life insurance, death comes to mind. That is the very first thing that comes to mind when you hear the word life insurance. Wow. And because no one wants to talk about death, even though the last time I checked, no one comes out of life alive, which means death is inevitable for everybody.
Right.
No one wants to talk about it.
Right.
And so when you associate life insurance and death, and no one wants to talk about death, hence they don't want to talk about life insurance. So you mentioned that sentence, life insurance. Everyone, turns it off. Another thing is life insurance is an intangible asset. What I mean is you can't touch it.
Yes.
A car, you can touch your car.
Right.
You can touch your house. You can touch your phone. So it makes sense that you insure what is tangible, what you can see, and what you can touch and feel. But because life insurance is a piece of contract, you can't see it, it's not tangible. Most people don't allocate it the value that it deserves. So I can understand why most people, especially immigrants, still have a bad relationship or a negative attribution to the word life insurance. But I can assure you, for those who know better, and there is a saying that if you go to Rome, do what the Romans do. If you come to the United States and you study most financial sectors, the topic of life insurance is very core to the United States.
That's true.
That's why they insist you have to get a car insurance or whatever insurance, because they understand that, that need to transfer risk. So because they treat it with so much, they place so much value to it. That's why the topic of life insurance is welcomed when you're talking to a Caucasian, someone who understands the value of it.
Right.
They're not scared of it. They're not turning it out. They're not, not interested, whatever. They are interested. They lean in instead of lean
Lean
out.
out. Yeah.
So I think it's how it's been portrayed, so to speak, in my humble opinion.
So how it's been sold to us,
Mm.
we're not really given the true benefits, the true value, and the true. I mean, we look at it from the financial standpoint.
Mhm.
You selling it, you are the one that they are looking on the fact that you are the one that is going to benefit,
Right.
rather than them.
Mm.
Why so?
Now I was when life insurance was explained to me,
Mhm.
because someone had to sit down and help me understand what life insurance actually is.
Yes.
Before that, I equally had the same mindset as everyone else. I didn't want to hear about it. I was working in IT, making good money. I didn't want to talk about life insurance. It didn't make any financial sense to me.
Right.
It was another bill I was going to start paying.
Yes.
And I was not interested in paying any more bills because I was paying enough as it was. But I was patient enough a particular day, and someone explained what life insurance is to me. Income replacement, legacy, generational wealth, tax-free growth. When they explained all these benefits to me, it made sense. But I'm not one to settle for just what someone tells me.
Right.
I went into my research
And
I read books and attended a couple of sessions, watched people who have, in the industry. And I came to that conclusion myself that it is, and I say this with the utmost honesty, it is one of the most misunderstood financial assets in the United States.
I did since we started talking about financial literacy, I started buying books. I read books, but this particular subject, I was not really, because I saw it as a burden.
Mhm.
But since we started talking and I started reading, now I got so open. I saw a very, very interesting facts that many don't see when it comes to life insurance. And is life insurance can be used in mortgages and in doing a lot of debt payment. Break that down.
Now, for real estate investors in particular, or those who understand how that works, life insurance, if you have the right type of life insurance, because again,
Yes.
we would have to go into what the different types of life
Yes.
insurances.
That is
But-
taking me to my next question.
But
So,
there are some types of life insurances that you can be leveraged as, for example, down payment on a home. It could be leveraged as a collateral, so to speak, to buy commercial real estate. And that's going to depend on the cash value in the life insurance, because, or in some situations, I've seen clients make the lender the beneficiary to the life insurance policy. So if at all I borrowed money from you and I died, so to speak, the benefit, one of the beneficiaries is the bank. So
yes.
if it's $1 million policy and I took a $500,000 policy and I made the bank, for example, a beneficiary to the $1 million, it means it's gonna pay half of it to the bank and then half of it to whoever the next beneficiary, the contingent beneficiary is. So yes, I have seen situations where life insurance is leveraged for business collateral, as accumulate funds for a down payment and stuff like that. So yeah, and again, it comes down to what type of life insurance and is it funded the right way, and does
Right.
it have all the aspects of what we're talking about. So it's not every life insurance that would do that.
I know that in the African community we have like a block mine where once you mention, just like you said, right, we already know that life insurance is a liability. It's an addition of more bills, right? So we don't want to be open to learn and to know what actually life insurance is all about. In my studies, there are different types of life insurance that serve different purposes, right?
Exactly.
I studied Mass Mutual. In our last show, I told you,
Yep.
I still had to go again and read. And in that statistics, they said many people conclude life insurance to death only,
Mhm.
and the wealthy are leveraging so much on it. Break down the different types of life insurance, and if possible, how do those insurance do they play?
So there are primarily two categories of life insurance. There is temporary life insurance and permanent life insurance. Temporary is very straightforward. It's what it's in short called term policies or term
Yes.
insurance.
Mhm.
So you get it for a period of time. It's the cheapest type of life insurance. So you can get it for 10 years, 15 years, 20, 25, or 30 years. There are some providers I understand that go up to 35 years. It's very straightforward. The contract basically says if you die within this particular period of time that you're insured for, we're going to pay out a lump sum to your beneficiary. If you don't die, then the contract expires. Then you may renew it or it lapses. So that is the very straightforward type of life insurance.
Right.
So I can understand why people attribute life insurance to death
Death.
because that is the most basic type of life insurance. It's available out there. You can get it for some as cheap as $10, $15 a month, $20 or $50 depends on your age and how much of the insurance you're getting. So that's one type of life insurance. Now there are some providers that offer a term insurance with living benefits, which means the life insurance doesn't just serve you when you die, it equally serves you when you're still alive, which means if you fall sick, critical illness, chronic illness, terminal illness, you can accelerate the life insurance policy while you're still living. So that's in the term category. In the permanent category, we have whole life insurance. Now, while this is temporary for however long you get the contract for, the whole life policy would run all the way to age 100. With a whole life policy, it's either a participatory whole life or non-participatory, which means they're paying in the participatory, they're paying you dividends.
Oh wow.
Yeah. So the premium you're paying, it's gonna be accumulating some dividends over time. All right. Now those dividends can be the money can be borrowed and or withdrawn to utilize for whatever you want to utilize it for. It's basically your money that is accumulating in those policies. All right. I'm trying to make it as basic as possible. So that would be a participatory whole life. Non-participatory is you're just paying for a straight 100 years. So you're gonna keep paying the premiums for 100 years. Now, I could go into the setups of these whole life policies. Now you can have a 10-year pay up, 20-year pay up, which basically means you would pay up the policy in 10 years. So they would calculate basically how much you would have to pay for 100 years, and then so you can front pay, so you front load it, so to speak. So you can pay for just the 10 years and you would have paid for the entire 100 years. So you don't have to keep making premium payments for 100 years, so to speak. All right. So you could do that. That just means your premiums are going to be higher.
Right.
So for example, if you're going to be paying $100 every month for 100 years, they're going to calculate how much that was supposed to be, then divide it by 10. So you're not paying that up faster, so to speak. All right. Then we have universal life. We have the whole life. Then we have universal life. In the universal life category, we now have indexed universal life. Then we have variable universal life. Variable, I can't speak on it because it involves securities. I'm not securities licensed, so I can't speak on it because it involves money in the market, ups and downs.
Right.
So I can't professionally talk on that. But in the indexed universal life category is where your cash is accumulating based on the underlying index. We're talking about the S&P 500. We're talking about the NASDAQ. We're talking about the global index or some other fidelity indexes, depending on the provider you're working with and which indexes they offer. So you could accumulate funds in your life insurance policy. Now, this doesn't make it an investment. And I want to be categorically clear about that.
Right.
The life insurance is in no way, shape, or form an investment and should never be sold as one. So when I'm talking to anyone, I talk with high net worth clients who invest in the stock market, who do all these fancy things with money,
Right.
and who are used to making quick gains. And when I explain how an index universal life, for example, works, they are quick to say, "Oh, so that's some sort of an investment." I say, "No. I'm quick to say, no, it's not an investment. It serves a primary purpose of protection. It is death benefit first. Anything else is an addition.
Right.
Living benefits, cash accumulation is an addition. All right. Now, you can leverage it to accumulate funds. You
Right.
can leverage it to do whatever, because once you withdraw or borrow that money, you can use it for whatever.
That's true.
But again, It is not an investment. It is not a savings. It should not replace your investment, so to speak. All right, but it serves that purpose of protection with that potential of accumulating funds over time.
Wow. In one of our episodes that we did on wealth building, we discussed about taxes and inflation. Where you made mention of the fact that the $100 of yesterday is $300 today.
100%.
Like what the $100 of yesterday can buy today is at least 300 or so. Now, how do taxes and inflation affects life insurance?
Let's say there are two things guaranteed: death and taxes in the United States, anyway. When it comes to accumulating money in the United States, there are very few portfolios that can help you do that tax-free. Life insurance, cash value life insurance happens to be one of those buckets that can help you accumulate funds tax-free. All right? Whole life, index universal life. The money you accumulate in these funds can be withdrawn and or borrowed without paying any taxes. Now we have for Roth 401ks, we have Roth IRAs that could equally accumulate your money tax-free. But when you look at how much you're allowed to put into a Roth IRA, $7,000 the last time I checked.
Wow.
So maximum $7,000 a year. I don't recall who said this. It's either Robert Kiyosaki or someone else. He said basically, whatever the IRS puts a limit on or a cap on contribution on, that's what you should go for. Because they only put a cap on what doesn't benefit them. Anything that benefits them somehow, there's no cap on it. For example, 401ks, well, there's a cap on 401k, but the cap is very $20-something thousand a year because you're going to end up paying taxes.
Right.
Stocks, there is no limit. You can put $1 billion in stocks. No one cares. Because
whenever
you sell, you're
going to pay taxes on it.
You can dump as much as you want in your bank account because whatever interest above $10, you're going to pay taxes on it.
Yeah.
But when it comes to Roth IRA, there's a limit.
Wow.
$7,000 because the money you put in there grows tax-free.
Huh.
So they're not if it grows to $1 billion, if your Roth IRA grows to $1 billion, you pay zero taxes.
Wow.
So how does that benefit the IRS? It doesn't.
It doesn't benefit them because you're not going to pay any taxes on it.
And then the other bucket where you almost have an unlimited tolerance to put in money is life insurance. That is why you're going to notice the wealthy don't joke when it comes to permanent life insurance because they can put in way more money in there. We're talking about $100 and something thousand, $1 million, into life insurance policies. Banks equally utilize life insurance, and this is public information, by the way. It's not me making.
Yeah.
You can look it up.
Yeah.
Right.
By the way, viewers, our shows, you can always fact check whatever we do. So we bring you relevant information, and it's based of you to do your own due diligence.
Yep,
okay, research, fact checked, because we give statistics. So, Mr. Bruno, thank you so much for pointing that out. Yes, go ahead.
So, when it comes to taxes, it is one of the best kept secrets. When you study the wealthy and where most of the liquid assets are sitting. Non-liquid would be real estate and whatever, business and whatever, but liquid assets means money readily available. They want to grow their money using the most tax efficient methods, right? Paying no more than they're legally allowed to pay to the IRS in terms of taxes. And so one of those loopholes in the system is life insurance. And those who know better maximize that asset class. That's why when you study the different how can I put it, entities, so to speak, banks, life insurance companies, if you look at the statistics on which of these entities go bankrupt, life insurance companies almost never go bankrupt. You can look as far back as 100, 200, 300 years ago. They almost never go bankrupt.
I was to point this out to you because during the financial crash, I was shocked. Life insurance was still booming.
Life insurance was bailing banks.
And that was why I wanted to ask you, why? What is really the secret?
I may not go into a lot of details, but banks practice what is called fractional lending. And I'm going to try to explain it to the most basic way I can. It may not be word for word or accurate, so to speak, but
Yes.
I love using metaphors because I believe if I just use whatever the textbook definition of a thing, it doesn't really sink in. So I love using metaphors to explain. So banks practice what is called fractional lending. So if we're 10 of us, all right, and we all give our money to the bank, and the bank lends out all that money. They have done the math. They have a probability. We're not all gonna come on one day to request our money. All 10 of us, maybe 2 people today, then 1 person tomorrow. Then they've worked out the probability of everyone coming to on the same day to withdraw money, and they've seen, well, we can lend out this money because
Right.
before A comes, C would have paid in something, and then when D comes, F would have paid in something. So we can keep rotating that money around. Now, what happens when we all come on the same day to take out our money? The bank has no money, and because they can't satisfy all our outstanding financial needs, they have no choice but to file bankruptcy. That's the simplest way I can put it on how banks go bankrupt, because they can't fulfill. Like 2008,
Mm-hmm.
what happened was, uh, when people since the real estate crash, they were like, you know what, let me go to pull out my money from the bank. Now, when we all rush to the bank and the bank cannot satisfy all those loans, what happens? They file bankruptcy. So that's the most basic way I can put it. Now, insurance companies practice what is called reserved banking or reserved lending, or whatever the term is. Reserve means they can't lend out more than what they have in reserve.
Wow.
And there are regulatory bodies in place to make sure life insurance are compliant. So, for example, you cannot operate as a life insurance provider if you don't have at least 2 times every outstanding promise. Outstanding promise is the life insurance policy you get, because
Right.
that's a promise.
Right.
Because for a contract to be enforced, there got to be an offer, acceptance, and consideration, which is the premium you pay. So once you get a life insurance policy, it's a promise that provider is making to you that if you die in the event of your death, we're going to pay out $1 million. It's a signed and legal document, right? So that's a promise I've made to you. So it means if any life insurance company has 1 million clients and they have promised every single client $1 million, I don't know who can do 1 million times 1 million. All right. Think about it for a second. It means that provider must have 2 times that amount in reserve, which means if every single 1 million clients die today, you should be able to reconcile to fulfill every single promise you've made. Insurance companies are mandated by law to have at least 2 times that amount. There are providers I work with that have 5 times the amount, 6 times the amount.
Wow.
Yep. Because I work with a very reputable platform. I may not mention the name, but that is one of they got to check your balance sheet to make sure you actually stand.
Right.
You're capable of fulfilling those promises. So because life insurance are very liquid.
Because things happens like
They are
this.
very liquid. So you must have that money because you have no idea when this person's going to die.
That's true.
So you must have that money liquid to
Available to
pay those
outpay those.
outstanding promises.
Wow.
So they are very liquid. That's why they can bail out a bank. They can front load investments, real estate. Most of the real estate you see around, when you dig deep to who is actually funding all these projects going on,
In
life
one way or
insurance
shape,
companies,
life insurance are there.
the bulk are the ones financing America, so to speak.
Yeah, I was gonna bring this question to you. Earlier it was last year, right? Where we had the longest government shutdown. And what shut the government down? It was premium, right? Insurance was at the forefront and corner of everything. Now, the question I want to ask you is this: how do life insurance helps you health wise while you are still alive?
So life insurance can or is an income replacement strategy, in that, depending on the type of insurance you have, of course, there are some that offer living benefits, which means you don't necessarily have to die to benefit from it while you're still alive. There are certain conditions you have to meet to qualify, so to speak. Most of them center around health, critical illness. Critical illnesses is things like cancer, stroke, paralysis, blindness, Alzheimer's, central nervous failure,
Kidney.
kidney failures, and all whatnot. These are critical illnesses. So those contracts state, aside from us paying you a lump sum or paying your beneficiary a lump sum if you die, it's an addition. It's called a provision, an addition to it, which is that if you're diagnosed with any of these diseases, you can accelerate. You can pull out money from your life insurance policy while you're still alive. And it depends on the provider. There are some providers that give you a percentage payout. Some of them give you a 90%, up to 90% payout. Some maybe 20%. Some depends on the provider you're working with and if they have that provision. So while you're still alive, you can be sure that if I get diagnosed, I've handed out a couple of checks myself to clients that I've worked with who are diagnosed with. I have one with pancreatic cancer. I have one with breast cancer. I have one with kidney failure that I've handed out checks to them. Substantial amounts of checks, by the way. So because they meet those criteria, they qualify for that life insurance policy while they're still living. The second is chronic illness, which in my opinion is going to happen to everybody living, especially if you live long enough. Because chronic illness is when you lose your ability to do 2 out of 6 activities of daily living. Bathing yourself, continence, dressing, toileting, which means you're going to get there at some point.
You get there.
Naturally, you're going to get to your 60s, 70s, and you can't do these things.
Right.
So it's going to happen.
Right.
Instead of, in a case of a chronic illness or long-term care, you can accelerate your life insurance policy as well. And if it came to terminal illness, which means you have less than 12 months to live, your life insurance policy, if you have the right type of life insurance policy that gives you all these provisions, you can accelerate your life insurance. So just from that, you understand that life insurance is not just about death. You're paying for something that you can leverage while you're still living to take care of you and take care of your family. I'm going to tell you a short story just to tie this up. One of these people I've mentioned, I'm not going to call names because I'm HIPAA regulated, but one of these clients I've worked with, he's in his 50s. He was done celebrating a anniversary with the wife, 20-something years of marriage. He was rushed to the hospital, diagnosed with pancreatic cancer. It was very severe, very, very severe. So he could not go to work anymore. He was at home, in the hospital for a very long time. Chemo was going to kick in. Now, this is where it became kind of interesting. He has health insurance from his job, and I recommend everyone get health insurance, especially if your job is offering one. Health insurance is very cheap when it's subsidized by your employer.
Right.
Yeah. So health insurance could only fund a portion of his chemotherapy, a portion of it. The amount every single month was so high, they said they could not cover all of it. And I remember receiving that call, and he said, "Bruno, what do I do?" Now, good thing is we designed the policy right, and he max funded it 2 years already. So he was able to pull money out from his from his cash value in his life insurance to start paying a portion of that chemo. Then what we did was we submitted a claim because the contract said if you get diagnosed with a critical illness, cancer being one of them, you can accelerate your life insurance policy. It was a $500,000 life insurance policy. So we filed for the claim, and because his was severe, stage 4, he was able to. They paid out $405,000 check. $405,000 check to him while he's still alive.
Wow.
Yeah. So I say that he beat cancer. That was in 2024. He beat cancer. And one of the reasons he beat cancer is because the last thing on his mind on his sick bed was, how do I pay the bills? Are my kids going to eat? The financial burden was not there because he had something to replace his income while he went through or focused on just getting well. So that's where life insurance becomes very important, especially when you're still alive.
I made a very a brother who were discussing. I came and I shared this with my wife, and this guy had a medical bill of 280,000. He came out from the hospital, and he said, "I'm more sick now than when I was in severe pain." He had cancer. The guy was talking to me and crying. He said, right now that because he beat cancer, but he said, I need to work 3 jobs.
You live with a financial burden.
So he said he needed to work 3 jobs to keep up with the bills. And up till this moment that we are talking about, even his 401k, Social Security, because the guy is about to retire, he said now, whatever he does, he was doing now menial jobs to survive. But still, I love what you are. So our main purpose here is, when we're educating our community, we need to do everything possible to let them get the right policy that is also, which they know that what I'm paying for is worth paying for.
Definitely.
I'm taking you to my last question here as we are rounding up here. How does life insurance help when it comes to funeral and their expenses? Because we are fond of GoFundMe.
I think we've made GoFundMe the norm in our communities, knowingly or unknowingly. I think so. Let me say this. I think it's a responsible thing for any man. Let me talk to the men. For any man, especially if you have a family, to think beyond just you, because I understand the reluctance with getting life insurance. It's an extra bill, right? But if you think beyond you, if you think beyond what happens to my family, my kids that I love, I don't want to say claim to love, because if I say claim to love, I'm probably insinuating you don't love your kids, and I know you do. So I don't want to say claim to love. But the kids you love, the spouse you care about, if you take yourself out of the equation, can they survive without you?
Wow.
So a life insurance policy is you making an upfront check to them and saying, hey, if anything was to ever happen to me, I want you to know I care about you. And it's my desire that the last thing on your mind, at least for a while, if not completely, for a while, is where do we get money from? Right? And I'm going to give you how you determine how much insurance to get.
Right.
So it is very important to understand the benefits, so to speak, of life insurance. And of course, there are multiple things I could go into when it concerns, wait, I think I lost my train of thought. What was the question again?
The question I asked was, how does it helps, life insurance helps when it comes to funeral?
Okay.
And our GoFundMe, because basically we've taken GoFundMe as a way to help fund a lot of funerals. But how does life insurance come into play to really help iron that out?
Perfect. So life insurance, of course, would, because let me say this. Funeral costs range from 10,000 and up. So it means the day any of us drop down dead, your family, your spouse, or your kids need at least $10,000 for funeral arrangements. Now, if you require your corpse to be transported back home,
that's another,
back to Africa, that is going to run your family at least $50,000 or more. So the question I have for you is this: do you have $50,000 or more laying around for that purpose? If the answer is a no, the question you'll be asking yourself is, where is it going to come from? Who's going to be responsible for that? You can't say my community. Community has their own things to worry about. All right. Now, the question I have for you is, because most of us fall back to GoFundMe and all whatnot, I want to ask you, how many times have you actually contributed to a GoFundMe? Let's say a brother or sister passed away and there's a GoFundMe list going around. How many times have you contributed and how much? So let's say you contributed your $20, because most people would send $20.
right?
So let's say you did $20 and 1,000 other people sent $20. Do the math. 1,000 times 20. And how many times do they actually do that? If at all you get 1,000, you probably get about 50 people, 100 people or so give $20. So at the end of the day, you barely make $1,000 from GoFundMe.
Right.
All right. If your community is so generous enough, it may go up to a couple of thousand, but that's still not enough for funeral.
That's true.
So life insurance is that upfront check to say, you know what? When I do pass away, which is inevitable, by the way, it can either happen now or 100 years from now, but it's going to happen.
The probability is one.
It's going to happen. So it's that upfront check to say when it does happen, this is a token, so to speak, to take care of me. Now, if you have a dependent family, there is something I want you to consider. I call it the dime, because you got to figure out how much life insurance do I actually need. All right. If your car requires, for example, $20 to top your tank and you only put $5, it's not going to take you all the way. It is something. I'm not discrediting what you have, but it's not enough. All right. So a lot of people have life insurance, but they don't have enough life insurance. And I'm going to give you a simple formula on how to go about calculating life insurance. It's called a DIME. DIME. D stands for debt, I for income, M for mortgage, X for expenses. And this is how you break it down. This is how you can do the math yourself, by the way. Now, your debt would be your credit cards, taxes, outstanding debt, whatever it is, car loans, whatever. Income is how much are you making? Because if you're making a certain amount of money, the question you'll be asking yourself, if I'm gone, does my family still need the same amount of money to survive?
Or do they need more?
Or do they need more, actually, right? Then mortgage, if you own a home, how much outstanding mortgage do you still have pending? Because if you still have an amount, I'm going to give you an example. Then expense, of course. If your kids have to go to school, funeral, and other expenses that have to happen when you're no more here, right? How do they go about doing all that? So let me give you an example. Let's look at someone who is making, we're going to do the dime, which is how much life insurance do you actually need, all right? Credit. You have credit card debt, you have taxes, you have some other debt, maybe school loans, blah, blah, blah. Those are
Car loans.
Debt. Car loans.
Yeah.
Let's say everything sums up to $50,000. So write down $50,000 as debt. Income. How much are you making? If you're making $75,000, how many years would you expect your family to keep making that amount of money to survive? So let's say 10 years from now. So 75,000 times 10. So we're looking at $750,000.
Right.
That is your income gone if something was to happen to you right now. Looking at mortgage. Let's say you bought a $400,000 house, you paid $100,000, you have $300,000 pending. So $300,000 outstanding mortgage. Then expenses. Your kids got to go to school, funeral expenses, emergencies, medical bills. That's one thing we're leaving out. Medical bills, which are ridiculously high.
Very, very high.
Right? You just mentioned $200,000 outstanding.
I'm telling you.
Exactly. So medical bills are very high. You spend a night in ICU, you look at how many thousands is sent to you, you wonder. So let's say every education, funeral, blah, 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 comes to $100,000, which in my opinion is very small. But if you add all this up, all right, if you add all this up, the dime, it means if you were to die today, what you expect or what you need to keep your family afloat is $1.2 million.
$1.2 million.
Yes. So $50,000 in debt, $750,000 in income,
What?
mortgage, $75,000 for times 10 years, that's $750,000. Mortgage of $300,000, expense of $100,000. Add everything and it's $1.2 million. It means if you die today, that's how much your family is going to need to survive for the next 10 years. Only 10. So if your kids are probably younger and they will not be 18 in 10 years, increase the times 10 to times 15, for example.
Wow.
That's how you determine if you have enough life insurance. Now, if you need $1.2 million, but you have a $200,000 insurance policy, is that something? Yes. But is it enough? No, it's not. Because if you die today, $200,000 cannot even cover the outstanding mortgage. It means you're going to lose the house, or the kids and your family are going to lose the house.
And they'll be homeless.
They're going to be homeless. They're going to move to an apartment or find someone to accommodate them. So that's how you determine how much life insurance you actually need.
This thing is, we need this data. And you remember in our last show, we didn't mention that men lie. We mentioned that men lie, but data.
Numbers don't.
Numbers don't.
That was my chapter for this morning. That's what I wrote this morning, actually. I said, men lie, numbers don't. Wow. You got to focus on the numbers. The numbers, I can tell you I have life insurance, and I'm honest. I have life insurance. Am I lying? No, I'm not. But when we look at the numbers, as I just pointed out here, do the numbers make sense? No, they don't. If you have 100,000 life insurance, is it life insurance? Yes. Is it enough? No. Right? But if you have enough, you must have sat down with a professional and go through what is called a financial needs analysis. That's where I do the dime with my clients. I got to sit down and we go through all of this. And that's where transparent. You got to be honest if you're really intentional about protecting your family. Because if you tell me the wrong numbers, I'm going to use the wrong numbers, and we're not going to arrive at the right number.
Earlier on, we're discussing about honesty and transparency. Mm-hmm. So I was saying you can be honest here and not transparent there. And you can be transparent here and you are not honest there. So it all depends on the subject matter at the same time. Mm-hmm. Mr. Bruno, I really want to sincerely appreciate you.
You're welcome.
Dear viewers, we have come to the end of this episode. If you didn't follow our first episode, please visit our YouTube channel and then you can follow other episodes. So we've talked about retirement at the age of 18. We've talked about transgenerational wealth, and we keep building on those episodes. So today we're looking at the benefits of life insurance. And I was so thrilled to have Mr. Bruno in the studio.
Thanks for
Mr.
having me.
Bruno, thank you so much.
Appreciate it.
We've come to the end of this episode. Our cameras and the sound system was taken care of by Mr. Harris. So thank you, dear viewers. And until then, see you.
100%.
Thank you.